you guys have been quite busy. I mean, there was the issuance of the green bond, then you went to the REITs market, then you upsized the issuance in the green bond as well. What next from a capital raising standpoint? Because we all understand the nature of REITs is that you are always aggressively raising capital.
A little busy is probably a bit of an understatement because all that was done in less than 2 years. Yeah, it has been busy, but I think it's all born out of the fact that we feel that there is inherent demand in the capital markets for regulated investment opportunities centered around real estate. I think what you're finding is that slowly a number of institutional investors are kind of realigning their strategies or their mindsets and looking more and more at asset-backed type of investment opportunities rather than looking at direct real estate investment opportunities.
Tell me, Raghav, there is a view that, I mean, you went to the market looking for 1.4, you've raised 2.1 billion, which is quite impressive. But there is the argument that, of course, this comes right off the back of the fact that EABL had an early redemption of its bond, 6 billion shillings worth of a bond. And maybe there's just too much liquidity in the market, and that's why the subscription is this high. How do you respond to that?
No, I mean, I think, look, I think we have to look at each issuance on its own merit. And I think, to me, the success of any issue is really predicated on the quality of the issuance, right? And the quality of the underlying assets. What are the fundamentals behind that issuance? If we think that just because, let's say there was a sudden infusion of additional liquidity that investors were like, okay, we'll just put our money anywhere. I think that would be doing a disservice to the investors as well as to the work that we've put in. I think the reason, in my opinion, for the oversubscription of the upsizing of the green bond was, in a sense, because of the effort that we've put in over the last 1.5 years, right? Where the green bond was already there. We have followed through on our coupon obligations. We've been paying coupon payments during the middle of a pandemic, which maybe a number of issuers might not be able to say. We also, with the launch of the REITs, because one of the projects that had been developed as part of the green bond, it was able, once it had been constructed and developed and it was operational, it was acquired by one of the income REITs that we have established. As a result of that, we were able to repay the principal amount against that project that was part of the green bond. So I think when investors saw that track record of us just servicing our debt obligations, consistently and without any hitches during the past year when we've all gone through what we have, I think that really was what's, let's say, sparked the demand, for this issuance. And the other thing, Julian, to bear in mind is that the majority of the take up for this upsizing was from the initial note holders, right? So 75% of the upsizing was taken up by the original note holders. So clearly, they're the ones who are seeing the proof of concept. They're seeing, what it's about, and they're happy with what it's about, and therefore they've taken it up. And I think what also pleased us was that other 25% that came in from a single investor who was new, who was very keen to actually participate in the notes program. So I think, given all that we've seen, I would say it wasn't necessarily circumstantial. I would say that it was more on merit that we, achieved the subscription that we did. Like you said, the 2.1 versus a requirement of 1.4 billion.
Speaking about the demand side, in terms of the pool of the investors you normally attract, it looks to me like Acorn is really skewed entirely towards the sophisticated, the guarantors, the EAIF and the likes. will you ever warm up to the retail side of the market, and what plans do you have around that?
No, look, that's a great question, and I think first of all, just to clarify, even in the case of the green bond, I think, like you rightly identified, it was only targeted at institutional investors because it was a restricted offering. We are, of course, going to list it as the first tranche was, but again, only available for institutional investors or sophisticated investors. Nevertheless, I agree with where you're coming from, by the way, on this. The green bond, sorry, the retail market. Apologies. The retail market is, I think, a significant opportunity from a capital raising perspective. But I think what is important is that you have to go to the retail market when you have really kind of established yourself as a quality issuer of capital market securities, right? I think there's significant potential. And I think the way to tap into that potential will most likely come through the income REIT. So we do, even when we were working on the income REIT and we were speaking to investors, it has always been a plan to eventually list the income REIT. But for us, right now, we want to show that proof of concept, right? We want to, work with the sophisticated investors who we see as collaborators in this process to show them, how we are performing, right? How the underlying assets are performing, how we are delivering dividends as we said we would, right? And on the back of that performance, when there is a certain level of education and a certain level of comfort with what we do, that I think is the right time to go for a public listing.
Many of the naysayers I speak to regarding Acorn will argue that these guys are heavily concentrated in student accommodation at a time when, for understandable reasons, the education landscape is being turned on its head. We are not even sure how the future of education will look like. How do you price in this risk, or how do you respond to that, Raghav?
Oh yeah, look, it's a great question, and it's something we come across quite often. But the thing, Julian, is to note is that now we're about 1.5 years into the pandemic, right? So to that extent, I think for us, and we've operated through it. We've seen it. I unfortunately we cannot say that we've seen it through. We're not at the end just yet, but hopefully, we can see a light at the end of the tunnel. Nevertheless, I think what the pandemic has actually, let's say, surprisingly, or maybe not surprisingly for those in the know, has shown to us is that this is a very resilient asset class, right? And why do I say that? Student accommodation is predicated on two fundamental needs in life, right? One is the demand for housing, and the other is demand for education. Those two needs do not go away just because there's a pandemic, right? People still need a roof over their heads, and they still need to study. Now, your point is, well, but what we're seeing is that on the need for studying, a lot of people or universities and educational institutions are moving towards hybrid learning, right? But our experience, and this is based on interaction with stakeholders, including university administration and including students themselves, they have found that in order for hybrid learning to work, they need two key elements. One is uninterrupted electricity, and the other is broadband internet access, right? That is not something a lot of the students who live with us are able to access when they are having to, when they were forced to go home, right? For those 3 months when the whole country was essentially in shutdown mode, right? And what we found was that actually that became a great divider almost, where it was, a difference between the haves and the have-nots, right? So what we found was actually once we reopened our properties in July, even though schools were not reopening, for the majority of last year, schools were not functional, physically for physical learning. We actually had a gradual ramp up in occupancy because the students were able to appreciate what facilities we were providing to them. And the other thing that people tend to forget as well is that these are young adults. Young adults don't want to be cooped up at home with their parents when they can be hanging out in their own community with their own like-minded peers. And that's something, when we even think about our own experience, that's what appealed to us about university life. But we seem to forget about that, when it comes to like being out of university 20 years on. And I mean, the last thing I'll mention is, again, I can speak in, let's say, conceptual terms, and maybe you'll say that's all hypothetical, right? But the last 6 months, even the last 6 months, universities have slowly started reopening, but a lot of them are, adopting that hybrid learning model, right? During this time, our portfolio average occupancy has been at 85% and above. And in fact, a couple of our properties are actually operating at over 95% occupancy. In fact, one of them even hit 100% occupancy in June, right? This is despite the fact that universities are not fully open. And what we are hoping for is that with universities now projected to reopen in September, towards the end of August and early September, hopefully they open up fully. I think the level of demand that we're going to see I believe going to be quite substantial, and hopefully hold us in good stead, because we're planning on also operationalizing more and more properties over the next few months.
Now that you've spoken about occupancy, let's talk about another dynamic which you must be considering, and that's rental yield. A number of players in the real estate environment I speak to, they're experiencing subdued rental yields, and just curious to understand how this is playing out for you, and how you're managing your cash flows, especially in light of the situation we have with COVID-19.
With our occupancy, like I said, with some properties at over 95% occupancy, our yields are healthy. We've very much outperformed our targets, right? You might have heard this before, but when you're in investment management, as with anything really, it's all about under promising, over delivering, right? And we had taken fairly conservative assumptions on our kind of expectations for how the properties would ramp up since the start of the year. And any investor who came into the REIT is already ahead of the curve, because, for instance, in Q1 we had expected 30% occupancy across the properties. We were at like over 70%, right? In Q2 we had projected 50% occupancy. We were at over 85%. Right. So any investor who came in at the early stage is already ahead of the curve in terms of their return expectations. And so our yields are steady, they're holding up. We're very much able to cover our operational expenses. So our net operating income is also healthy across the properties that we have that are operational. It again points to it just points to that resiliency. There's a certain defensive nature of these asset classes. And when you look at more mature markets, I mean, you'll be surprised at the statistics we're seeing. I mean, they didn't even shut down their properties, even though they're all on online learning, and I think over time, that's the same type of dynamic that you're going to see with us in Kenya.